Stocks are lower now after the Dow and S&P again hit record highs earlier on. Investors seem to be weighing the benefits of a half-point cut versus concerns about any economic weakness. But if history is any guide, my next guest says stocks will rally because they're always higher a year after the Fed starts easing when we're within 2% of all-time highs. Got that? Joining me now is Ryan Detrick, Chief Market Strategist at Carson Group, and Sandy Villere, Portfolio Manager at Villere Co. Welcome to both of you. Ryan, how big is that sample size?
Well, Kelly, thanks for having me back. Yeah, 20, right? There's obviously not a ton, but I think it's more than people think. People are like, can the Fed really cut their all-time highs? Yes, they did multiple times just back in 2019. But I took a look. When you close within 2% of an all-time high the day before the cut, what happens next? It is what it is, up 20 times out of 20, up the S&P up about 13.9% on average. Lots of other stuff to consider. We understand that. But that data point by itself is something that should comfort the bulls, we think, here. Especially,
as I'm sure you've heard, Ryan, a lot of people would say maybe it's a mistake for the Fed to be easing with stocks near all-time highs.
Well, you're right. We've heard that. Or should they start with 50? Because obviously when they started with 50 in 2001, 2007, bad things happened. We were the camp 7 weeks ago. They probably should have cut 25, so this brought the eraser out. But all in all, I mean, last comment here, what's the economy up to? I mean, labor is slowing, yes, but we just had initial claims at a 4-month low last week. So all in all, the economy's slowing, not going into recession. Still should bode well for investors here.
Do you, just before I turn to Sandy, do you see any evidence, we were talking about this morning, that stocks are frothy, overextended, in other words, that they're going to kind of push us to new highs, but in a way that's not sustainable?
No, we don't think so. I mean, you look at forward S&P 500 earnings, just hit another record high. Profit margins continue to grow. Yes, October in an election year, as everyone's going to talk about a lot, is the worst month in an election year. So those near-term choppiness is there. But bottom line, no, we don't think this is frothy at all. I mean, small caps, they're not even hitting all-time highs. I think we can talk more about them. But small caps aren't even hitting all-time highs yet. So it's hard to say it's frothy when big parts of the market still aren't even making new highs yet.
And by the way, we're showing you right now next to Meta CEO Mark Zuckerberg, who's just taken the stage for his Connect event to begin. Maybe 15 minutes late, but we'll hear much more about the hardware they're going to launch and some of their AI initiatives. But Sandy, instead of talking about the Mag 7, I want to talk about what Ryan was just about to kind of allude to, which is a lot of people expect small caps to do quite well from here on out. Obviously, you'd be one of them being a small cap stock picker. But do you want to add any nuance to that, to what you expect in terms of their performance?
Yeah, it's interesting. If you look at some other data, right, you go back to 1950 and all the rate cut cycles, small caps have done about 27% 12 months after that first cut. Large caps about 15%. So in my opinion, the wind is definitely at our back. And if history doesn't always repeat, but it certainly rhymes. So we think small cap, and the other 493 stocks in the S&P have maybe some opportunity to outperform, what the Mag 7's done looking forward over the next 12 months.
It is strange, though, that this is going to be the case, that the Russells have underperformed big tech since the Fed rate cut. And, people say, it's just a couple days. Oh, they outperformed going into it. But look again at the price action today. The Russell's lagging.
Yeah, I mean, I think we're going to get some volatility in October for sure prior to this election. And I think on these dips, certainly in small cap, I think you can add to them. And maybe we need to see a little bit more of just a little bit more of a pullback. But I think this is the opportunity. And again, if you just look at history, it looks pretty bright because we should get another 50 in 2024 as far as rate cuts. And we should get another 4 25 basis point cuts in 25. So it looks like, again, the wind is at our back. And I think small caps are going to be a great place to be allocated.
We've talked about a couple of these names here before. You've liked Caesars and Freeport-McMoRan, I think, for quite some time. Tidewater is also on your list now. I don't know if you can kind of talk about those or a few others. How long is the time horizon here that you think you can own these and do well?
Yeah, I think 12 to 24 months. My favorite holding period is forever. So we plan to put these away for quite some time. But I think with lower rates, you look at Tidewater, that should keep, energy with consumption pretty constant. But that's a very specific story about just no new boats being built, right? They're the largest OSV fleet in the world. And with no new boats coming on, their day rates have gone from 10 to 20,000 already. And we think they're going to go to 30,000. So EBITDA is going to triple between 23 and 2025, which is amazing. And I think there's going to be a lot of opportunity in Tidewater as well as Freeport and Caesars. It's got a little bit of leverage. So with lower rates, it's almost like pouring gasoline on a story like that, which should be good.